What if I told you that one of the biggest shifts in investing is happening outside the stock market, and most investors are only starting to notice it now? Private markets were once reserved for pension funds, sovereign wealth funds, and the largest institutional investors. Today, they're rapidly becoming one of the most important forces reshaping portfolio construction. And the numbers are hard to ignore. According to Preqin's long-term forecasts, private markets are projected to reach roughly $26 trillion in assets under management by 2030. Or around $30 trillion when hedge funds are included. What was once a niche corner of finance has become a major pillar of the global investment ecosystem. To understand why, we need to go back to the years following the 2008 global financial crisis. For more than a decade, interest rates remained historically low. Investors faced a simple problem. Traditional safe assets no longer generated enough return to meet future obligations. As yields declined, capital increasingly flowed toward private equity, private credit, real estate, and other alternative investments. But yield wasn't the only attraction. Private markets offered access to opportunities that were becoming harder to find in public markets. Here's a statistic that surprises many investors. Since 2000, the number of publicly listed companies in the United States has declined by more than 30%, while the number of private equity-backed companies has grown more than sixfold. Think about what that means. A growing portion of economic activity, innovation, and company growth is happening before businesses ever reach public markets, or without going public at all. At the same time, concentration within public markets has continued to increase. By late 2025, the 10 largest companies in the S&P 500 represented more than 40% of the index's total market value. Information technology alone accounted for roughly 35% of the index, higher than the peak concentration seen during the dot-com era. For many investors, private markets represent a way to expand beyond an increasingly concentrated public opportunity set. But here's where things become more complicated. Private markets aren't simply public markets with higher returns. They come with different liquidity profiles, different valuation methods, longer investment horizons, and unique portfolio construction challenges. Unlike publicly traded securities that can be priced every second, private assets are typically valued periodically. That can create smoother reported returns, which may make risk appear lower than it truly is. As a result, institutions have developed increasingly sophisticated frameworks to determine how private assets should fit within strategic asset allocation models. And finding the right allocation is only part of the challenge. Actually deploying capital efficiently can be even harder. Private equity funds often have investment horizons of 10 to 12 years or longer. Private credit funds frequently operate across 7 to 10-year cycles. Capital is committed up front but deployed gradually over time, requiring careful planning around cash flows, distributions, and future commitments. Historically, these characteristics created barriers for smaller investors. High minimum investment requirements, long lockup periods, and complex fund structures meant access was largely limited to major institutions. The first wave of democratization arrived through fund of funds and feeder structures, allowing smaller investors to participate indirectly. Now we're entering the next phase. Technology, product innovation, and expanding distribution channels are bringing private market exposure to a broader audience than ever before. Industry forecasts suggest individual investors could represent approximately 22% of private markets assets under management by 2030. That's a profound shift. The story of private markets is no longer just about institutional investing. It's about access. It's about expanding the investable universe. And it's about giving investors exposure to opportunities that increasingly exist outside traditional public markets. The question is no longer whether private markets matter. The question is whether investors can build the knowledge, discipline, and portfolio framework needed to use them effectively as this transformation continues to accelerate.